Translation exposures is the risk that a company's equities, assets, liabilities, or income will change in value as a result of exchange rate change. This occurs when a firm denominates a portion of its equities, assets, liabilities, or income in a foreign currency. The value of every item in the balance sheet except capital is converted using the current rate of exchange. The stock of capital is evaluated at the prevailing rate when capital was issued. The balance sheet has to be rebalanced as a result of this accounting procedure. The CTA is used as a plug-in figure that nets out the asset side of the balance sheet with the liabilities and the equity side. Monetary items such as cash, account receivable, account payable, and long-term debts are translated at the current rate, while non-monetary items such as inventory, fixed assets, long-term investment are translated at historical rate.
So next is the temporal method. So the temporal method is a currency exchange methodology, which is it won't be converted to the currency. That is distant subsidiary, which is usually business and into the current utilized by the parent's company. So the most important equation for this method is retained earning, which is ending, equal to retained earning beginning plus net income minus dividend. So for the final method is current rate method. Current rate method is subsidiary which isn't well integrated to the parent company. So therefore, if the native currency wherever the subsidiary operates, that will be the same as the functional currency. So for the first method that been used is weighted average. Second, asset and liabilities in balance sheet. Third is record to rebalance.
International accounting standard refer to any accounting standard that apply to organization across border. The IAS were replaced to International Foundation Reporting Standard (IFRS) in 2001. The role of international accounting standards such as: first is full discretion in developing and pursuing its technical agenda. Second is the preparation and issuing of the IFRS and exposure draft. Third is the approval and issuing of the interpretation developed by the IFRS. There are many Iisb framework purposes are. One of it is it assists the Iisb in the development of coherent and consistent in the accounting standards.
And the first one is the series publisher between standard. And the second one is the standard period between International Accounting Standard and also International Financial Reporting Standard. And the third one is the rules between standard. The challenge of the International Accounting Standard IAS is the different local regulation for every country and also consolidation of entities in a group. And the solution of the challenge is calculation of impairment of investment in subsidiaries, and also transfer pricing and cost allocation between companies. Thank you.
The translations is most noticeable in multinational corporations because portions of their operations in asset will be denominated in foreign currency. Consolidated financial statement must be prepared by parent companies, which combine the parent's balance sheets and income statement with the balance sheets and income statement of the subsidiaries. The difference between transaction exposure and translation exposure is accounting measures, origin affiliate, tax, timing impact, value impact, occurrence, profit and loss.
Next, management in translation exposure. First is balance sheet. A balance sheet hedge is where a company matches its asset in foreign currency X with the same amount of liability in the same foreign currency until its net exposure in each currency is zero. This is an example that the exhibition above shows that the fact that there are 1,826,000 euro net export asset than liability. Second is derivative hedge. The use of derivative contract for hedging purpose may involve speculation, but if done carefully, this method manages its risks. First, it actions. A currency exchange agreement between two entities for the exchange of cash flow over a period of time will help manage risk. Second option, a currency option gives the party the right but not the obligation. Third is forward. Two entities enter into a contract with each other for a specific exchange rate for the settlement of a transaction at a fixed date in the future.